You're watching Morning Live. Thanks so much for being with us. Now, members of the Finance Portfolio Committee in Parliament on Wednesday vetoed a proposal by the Democratic Alliance to allow individuals to use pension funds as a loan surety. Now, in a private pensions bill, DA member Dr Dion George proposed that pension funds should be used to provide surety for a lender to guarantee a repayment in the eventuality that the debtor is unable to pay back the loan. However, some investment experts say that using pensions as a loan guarantee would likely do more harm than good, especially for those at the lower end of the income scale. So on this, we're joined now virtually by Dr Thanti Mthanti, who's a senior lecturer at UCT Graduate School of Business, to help us unpack this further. Dr Mthanti, good to see you. Welcome to Morning Live.
Morning, Sakina. Morning to your listeners.
So straight into it, some experts say the proposal might be well-meaning, but that it's not necessarily well considered. What's your view?
Well, I think it's coming from the point of there's been fairly limited assistance by the government for a lot of people through the COVID crisis. And some of those people are really in strain. We've seen the unemployment numbers, they've shot up. I think we've lost about 2.1 million jobs. And we don't have much unemployment insurance. The economy is pretty weak. I think it's coming from a place of saying, well, if I've got this pot of savings, right, and I'm still working, say I'm not unemployed, but I'm still working, but all of a sudden I'm facing all of this pressure because of family or whatever who've lost jobs, people who are sick, or whatever the case may be. Can I tap a bit of my savings to help me through that crisis?
So for those who say that this is not necessarily something that's well thought out, I guess they're coming from the point of view that would suggest that your pension fund, your retirement fund should not be touched. It's money that should stay there as a nest egg. And the current situation in South Africa is such that those who are working, those who actually do have these funds available, have become a precariat, as it were. So what does it say about our current economic status as a country and also our policies that have rendered us in this specific position?
Well, from the policy side, a lot of people, the government just didn't provide a lot of what we would typically call pandemic insurance, right? So people were told not to work, businesses closed, economy is weak. And a lot of them, it was, hey, sit to finish. Look after yourself. Basically, there wasn't much. There was hardly any support provided. And as I indicated, people are straining. A lot of people have lost, if you are a dual income earning household, one partner has lost a job, you are straining at work. You're straining to maintain your bond payments. You're straining to keep your kids in school, and you've got this pot of savings, and it's becoming attractive. Well, if the government won't assist us, why can't we tap into this?
And help ourselves, essentially, as you say, see to finish. But the proposal says that the money is not a direct loan, but will be used as surety for a loan. So explain to us, what difference does that make, if any at all?
So effectively, it would allow a bank to lend the person money, and they would take a portion of their retirement fund. I think currently the proposal is at about 30% as surety. It would be better if it just allowed the limited withdrawal without involving financial institutions or whatever. It would be easier if it just allowed a limited withdrawal. Say you could withdraw 10 or 20% of your pension fund assets that you've accumulated in a crisis.
So speaking of the pros and cons, what are they when using your pension fund as surety for a loan?
Problem is you don't service the loan, the interest could accumulate. There could be penalties, right? We've got a pretty abusive financial sector in South Africa. We know with the micro-lending sector, the heavy interest charges that are there, the heavy administrative charges that are there, which is why, in my view, it would be better to exclude the banks and financial services companies generally from it and allow a limited withdrawal without the unnecessary charges, really. I mean, if you've got 2 million in your pension fund, you need 200,000. Surely you should be able to withdraw the 200,000 in light of perhaps the government not being really interested in providing any support to the economy or to individuals when the economy is going through a massive crisis.
So, just in breaking it down a little further for those who may be considering taking this particular option, what would it mean for someone who's sitting there today thinking, okay, I need a loan of 10 Rand and I'm going to use my pension fund as surety for that? What are the implications of this act?
Well, the first implication is he'll have 10 rands less for retirement unless he settles that loan in full, right? Unless he settles. And if he defaults, right, obviously the financial institution will be able to grab some of his pension fund, right? That's where the big risk comes in. What will the charges be that the financial institution is grabbing in this pension fund? Already people don't have full control over their pension funds. A lot of asset management companies in South Africa charge quite a lot of money to manage those pension funds, right? Number two, they tend to invest in related funds, right? Number three, now you'll introduce a banking sector into these funds that can also levy their own fees and additional charges. It could be a bit of a dodgy area. I think a limited withdrawal makes a bit of sense, but even a limited withdrawal will have implications because the pension fund industry is one of the underwriters of the government bond market, for example. They buy quite a lot of bonds. They buy quite a lot of shares on the JSE. So the government bond market could get a little bit shakier, I suppose, in terms of crisis if a lot of people withdrew their pension funds.
So the status quo has been just that, speaking about government and government bonds, underwriting some of these, etc. We heard, for example, the ANC last year proposing the use of pension funds to be utilized for infrastructure projects. And, we know about the PIC, its investments. And this has always been, quite questionable for me in the sense that you use pension funds and people's pension monies for projects, and inevitably there are some people who are able to enrich themselves doing that, using those funds. But how much of that actually accrues to the actual pension funds? How much does it actually assist or improve the situation of the actual holder of a particular pension fund? So if they come in and say, okay, started out, I have about R1 million that is now being invested somewhere through PIC and its projects, its investments, whatever. At the end of the day, how much of those investments and whatever accrues there comes back to me as an individual pension fund holder?
Well, on the amendments to Regulation 28, I think the second draft has come out, and the call for comments again. It's more, the government is encouraging pension funds to invest in infrastructure. It's not actually forcing them. It's not forcing them. So it's encouraging them, and it's put the limit at 45%, so they can invest. They're defining infrastructure as an asset. It's not only government assets, it's not government infrastructure projects, it's also private sector infrastructure projects that they can invest in. So I think people can be reasonably assured that the guys are going to invest money on the basis of how much returns they can get from those infrastructure projects, because they're not compelled. They can assess those projects on a case-by-case basis and look at the sort of returns that the pension fund members will get. So in that one, it's unlike the PIC, for example, where you had a lot of connected lending, investments being allocated to companies or to projects that made no financial sense whatsoever. And some of it was almost tantamount to theft.
All the same, in terms of those returns, how much of that actually goes back to individual pension fund holders? Do they actually see a return on investment, as it were?
Yes, they do. I think the returns in pension funds have been low over the last 10 or 12 years, partially because the JSE has performed badly, right? It's performed badly, say, compared to other markets, and in general, it's been pretty flat. It's performed badly. And we've got exchange control regulations here and Regulation 28 that limit to what degree pension funds can invest offshore. So if the South African economy is generally poor, that will reflect on the pension funds, right? But that still doesn't excuse the heavy charges in the pension fund industry. The preference, for example, for using active fund managers rather than using passive fund managers that would charge a lot less, right? Not too many pension funds use, for example, index funds, right? Why? A lot of them, you'll have a pension fund with Old Mutual, and the funds are then largely given to that particular company's asset managers. Why, right? There's no effort. But some of the questions not only has to be asked by the pension funds, a lot of the pension fund members need to also ask their own trustees. What are they doing about costs? Why are they not generally looking at more passive investment strategies, looking at cheaper index funds? Why are they using, the problem comes there. There's a very bad nexus between the trustees and the administrators sometimes and the asset managers.
And as you say, the actual fund holders need to ask more questions. You know, what is happening with my money? How is it being spent? Where are we invested, etc. But these are things that I don't think necessarily happen as regularly or even as one would like to see at all. But just a final question, Dr. Mthanti. So even if the infrastructure investment is a great idea, what would guarantee that people's pension funds are actually safe, considering the level of corruption that you touched on, the mismanagement of public funds, with seemingly no consequences for those who actually squander these public funds?
Well, the advantage with the reform of Regulation 28, at least the way it is done, is that if for example, your asset manager is Old Mutual or Investec or whatever, they won't be compelled to invest in any government project. They can invest in 0 government projects. They can also invest just completely in private sector projects, right? That will make them a return. And the government projects they'll invest in are government projects that will make them a return. And if they don't, they can pull the funds. It's that straightforward. So I don't think pension fund members need to be necessarily worried that if now infrastructure is defined as an asset in Regulation 28, all of a sudden their money will be looted. There will still be governance processes around their money by their trustees. There'll be governance processes in the asset management companies that actually look after the money. So there is really no need for any major concern.
Dr. Mthanti, thanks so much for your time. We have to leave it there. Dr. Thanti Mthanti from the UCT Graduate School of Business, weighing in on the arguments that are for and, of course, against the use of pension funds as loan surety. And that brings us up to news time. Leanne standing by with that.